And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week. Michael Lebowitz joining me this morning as well. Talk a little bit about the inflation reports yesterday and, of course, Tuesday. We had CPI and PPI. We'll talk a little bit more about that today, particularly what that means for the Fed outlook. As you know, interestingly enough, yesterday's PPI report came in flat at zero on a year-over-year basis. We're still not seeing, after 5 months now, this big tariff inflation expecting to impact the U.S. economy. And remember when tariffs were first introduced, it was like, oh, this is terrible. This is going to take us back to the Great Depression. And if you have done any research in history at all, you find out that tariffs really aren't as inflationary or recessionary as a lot of the headlines made it out to be. And we're now seeing that again kind of in real life up to this point. And one of the important factors is that the economic makeup today is very different than it was back, say, in the 70s, when you had 80% of the economy that was manufacturing based, which means we required a lot of raw materials, raw products, those type of things to manufacture things that we were then selling to U.S. consumers. Services were about 20% of the economy. Today, that's reversed, and services now make up about 80% of the economy. And, it was, as we were talking about yesterday, 75% of restaurant sales are now driven by delivery. Only 25% of their sales actually occur in the restaurant. So when you have that big of a dependency on services, which are not tariffed, it's hard to get tariffs to actually show up in the economy. Take a look at corporate revenues as another kind of measure here. Corporate revenues, about 75%, 80% of corporate revenues come from U.S. sources. So again, in an economy that's 80% services, that's really not surprising, considering that most businesses now are providing some sort of service, whether it's DoorDash or Uber, whatever it is. A lot of services, those aren't taxed through tariffs. And so if you got 80% of revenues coming from U.S. sources, that avoids a lot of that tariff impact, and that's again why producers aren't showing a lot of impact from tariffs. Now, are there little points within the economy that tariffs are showing up? Yes, absolutely, right? We talked about that yesterday. If you dig deep enough into the CPI report, you can find some tariffs in appliances, which we import a lot of those things from overseas. So again, it's important though to separate out, as is always the case, narrative versus kind of reality. And again, we haven't seen that. Now, does that mean we're not going to have any impact at all, zero, none from tariffs? No, that's not what that means. There's going to be areas of the economy that are impacted by tariffs. There's areas of the economy that are now being impacted by tariffs. But from a market perspective, again, we always kind of step back, separate our personal biases and what's going on in our own personal life, and look at what the market cares about. Market cares about the headline numbers. What does CPI and PPI say? And all that means is what does that mean for the Fed and what are they going to do next? And again, we'll talk more about that with Michael Lebowitz this morning. But again, just, it's important to kind of keep the narrative in check with kind of what's actually happening within the overall economy. Now, outside of that, we've got retail sales today. Earnings have been coming in. They're okay. Again, not, kind of unsurprisingly, we lowered the bar so much that, we've got a lot of companies that are beating estimates, beating earnings, but they are weaker. We're seeing weaker earnings growth, weaker revenue growth. We should grow earnings at around 4 to 5% for this quarter. That's a fairly weak number that we've seen here recently, but expectations are very elevated. That number is going to accelerate into the end of the year. I'm a little bit more sanguine on that kind of outlook because of what's happening economically. We're seeing economic data continue to slow down. Retail sales today are going to be another important point. Retail sales make up about 40% of personal consumption expenditures. Personal consumption expenditures make up 70% of the GDP equation. So now that we've gotten all of that trade, pre-tariff, trade imbalances that were kind of screwing up the GDP reports in the first quarter, we're now going to start to see in the second quarter, kind of the reversal of that as well, but also this kind of impact to retail consumers. And if that continues to come in weak, we should expect weaker economic growth later into this year as well, because again, consumers make up 70% of the economy. So here's what you need to know before the bell this morning. As I said, earnings continue to roll in here. We're getting right into the heart of it. Netflix is out today. A lot of big companies are starting to report. Next week, we get really into the heart of earnings season. The next 2 weeks are extremely busy on earnings, and we're going to have lots of earnings reports driving markets. And then, importantly, the buyback blackout window opens back up at the end of the month. So we should see, typically, seasonally speaking, starting today, tends to be a little bit weaker period in the markets as we kind of process earnings. A little bit more volatility pick up, won't be surprising. But again, this kind of market action has been fairly weak already. As we talked about a bit yesterday, we've already been kind of just slogging around here over the last, really kind of couple of weeks here. We're pretty elevated above the moving averages as well. As I noted in today's daily market commentary, a reversal back to the 200-day moving average is about a 6% decline. And that's certainly well within historical norms for a corrective or consolidative pullback. The one thing that really kind of, I don't have a lot of worries about the market right now. There's nothing out there that suggests we're going to have a big crash coming at any time, at any point here soon. We just don't have kind of the economic backdrop for it just yet. But one thing that does concern me is the level of retail speculation in the markets. Retail investors are now making up 14% of the trading volume. That is the highest level on record and higher than it was. We hit a peak back during the kind of the meme mania in 2020, 2021, when everybody was chasing, retail investors were sitting at home, they had no job, couldn't go anywhere, so they were just trading stocks on their phones. That kind of meme mania, they made up 12% of trading volume at that point. They're now at 14. Again, this is a lot of single stock speculation, a lot of kind of leveraged ETFs, those type of things, and we're seeing this across asset classes in general. But we're seeing that's the one worry here when you typically have that kind of big spike in retail speculation. That typically is closer to a near-term market peak. Again, just it's always kind of the contrarian indicator. Now, does that mean things are going to basically, fall apart tomorrow? No. As we saw in 2020, it went all the way through 2021 before we actually had the pullback in 2022. So it can last a while, the speculation level. But that does worry me just from the standpoint that it is getting very, very elevated here, very exuberant in terms of positioning, as well as overall sentiment, and that typically is a setup for at least a short-term correction. That's why I'm kind of watching this 200-day moving average very closely here. That would give you a decent correction. It would work off some of that speculative kind of fervor. We are on a short-term momentum signal. We are working off slowly. This kind of slog in the market here over the last week or so has really started to work off some of that overbought condition, but we're still overbought here and still very deviated from mean. So I can't kind of stress enough to do a little bit of work in your portfolio. Just take some profits, rebalance some risk. Yesterday we added in our platinum model, we added some out of the money S&P puts for October just to try to hedge portfolios here just a bit. Again, just insurance here, when you have this kind of speculation in the markets, and particularly when you have very, very low levels of volatility, which has kind of been the hallmark of this market over the last kind of few weeks in particular, insurance gets very cheap at this point. And so again, you should not ignore risk in your portfolio. And again, with insurance cheap right now, think about, hey, a 6% correction ain't nothing. And I'm not saying it's going to happen, but there is a risk of it. And with insurance cheap, it certainly makes a lot of sense to add a little bit to your portfolio. So again, that's what you need to know before the bell this morning. That's just what I'm thinking. But we'll come back, pick up with Michael Lebowitz right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. It is, of course, Thursday, which means Michael Lebowitz joining us this morning. And I want to talk a little bit about the Mag 7 here. We've got a lot of stuff to actually talk into. We're going to talk a little bit about the Mag 7 this morning. But also just, as is always the case, after two inflation reports, kind of the question is, what does this mean for the Fed? What's the outlook? And again, the whole market's kind of all based upon what the Fed is going to do next. Is the Fed going to cut rates? Are they going to just stay neutral? Or are they going to hike rates? Whatever the question is. And this is unfortunate because we no longer really pay much attention to fundamentals, but we just kind of really pay attention to whatever monetary policy is. So, Mike, last couple of days, both inflation reports didn't really show much inflation from tariffs as been expected. Of course, Jerome Powell has been, kind of on the fence, adamant that tariffs are going to show up here, that it's going to be inflationary, so he doesn't want to cut rates. Kind of what do you think that the Fed's thinking now?
I don't know what they're thinking. You look at PPI.
Mm-hmm.
I thought PPI was 0.0%. There was no inflation.
Mm-hmm.
It was 0%. And PPIs, even though the market follows CPI, we follow CPI. It is that and PCE are kind of the two benchmarks of inflation. PPE tells you where CPI is going to be to some degree, right? That's input prices for the manufacturers. So when a company wants to build a car, PPI is measuring the cost of steel and rubber and plastic and everything else that goes into that car. And they're basically telling you that those input costs did not rise last month. And further, for the last 3 months, they've been just a hair above 0.0%, below 0.1%. So those input costs are not necessarily flowing through to the consumer. So then the question is, can companies raise prices anyway? And we're getting a lot of indications that the answer is no, right? Retail sales have been weak. Other measures of the consumer has been weak. We know sentiment has been poor. So, we just got June data, So we know through June that the impact of tariffs, and like you said, Lance, it's certainly affecting some products, but the aggregate effect is minimal. And, if I'm at the Fed, I'm starting to wonder, is the combination, there is an impact from tariffs, but is the combination from the, still going back to 21, 22, that wearing off along with a softening economy, is tariffs a thing that is stopping inflation from becoming disinflation and possibly even deflation? And if that's the case, tariffs may be the Fed's best friend because it's allowing them time to cut rates before the tariff impact goes away and you're left with a softening economy and just a natural trend, which could lead to below 2% inflation. So I don't know what Powell's thinking. Powell's stuck in a political quagmire as well. So I'm sure his ego is now in overdrive. But we're hearing more and more Fed speakers kind of come out with a more dovish tone that, the impact wasn't as bad of tariffs isn't as bad as feared. But again, I'll say it again. I want to see the July data and the August data before taking any victory laps. But certainly the data we see doesn't show a huge impulse from inflation, from tariffs.
Yeah, no, and again, like I said in the opening, is like it doesn't mean that tariffs aren't going to show up, and they are. If you look at appliances and some other things, you're certainly seeing impacts from tariffs. And as is always the case, if you dig deep enough into anything, you can find the answer you're looking for, right? But overall is kind of what we're looking at. And again, very important, as I said earlier, it's very important to separate out your personal kind of feelings towards inflation or tariffs or the whatever your feelings are towards the president. Separate those out. You may not like the president. That's okay. You may not like his policies. That's okay. Nothing wrong with your personal biases, but don't let that affect your influence. Don't let that influence your investing decisions, because what the market cares about is the headline data, and they only care. You may not agree with CPI and the way it's measured. Got it. I understand. But the market doesn't care about that. What the market cares about is that data print. They care about PPI, it cares about CPI, because they care about what monetary policy is going to be and how that liquidity impulse of however it shapes itself through either increased monetary supply or lower interest rates or whatever it is, how that's going to impact asset prices. So again, it's always important to separate out personal biases versus the data that we get. And again, Mike and I, we dig through a lot of this data on a regular basis. We dig into the employment measures. We see where the fallacies are with things like the birth-death adjustment or the seasonal adjustments. We see all that, right? So Mike and I, we agree with you in on a lot of bases that a lot of this data doesn't represent what our reality on the ground is, but doesn't matter for the stock market. That's the important thing when we're investing, is to just focus on what this data means and how the market's going to respond to it, regardless of how we personally feel about it. Mike?
And it's, how does it change the narrative, or does it support the current narrative? And the question du jour yesterday in my email box was, what's going on with bonds? We had a relatively tame CPI, 0% PPI, and bonds yesterday were flat, give or take a little. And we know the reason in hindsight. There was the Florida representative came out that said Trump's going to fire Powell imminently. The market, both stock and bond market, fell sharply, quickly. Trump comes back and said, I'm not firing Powell unless there's fraud. And that upset the bond market. The bond market came back but didn't regain its highs. And we've seen this theme over and over again, where the bond market just doesn't care about the news. It's this overriding, got to sell bonds because of whatever the narrative, right? We know that tariff inflation is not an issue yet. We know that the deficit, we ran a June surplus. First June surplus we've had since
2017.
I believe 2016. Either way, that's a rarity. Tariffs are helping. They're cutting the deficit. Spending, cutting expenses is starting to help as well. There's, again, the inflation, the employment is weakening. We're probably going to get a weak retail sales number. All the fundamentals for bonds are getting stronger and stronger, but the narrative, the tone of the market doesn't care. And you see it in Japan and other bond markets too.
Yeah. And again, you have to remember that, and I get these questions a lot as well. Mike is like, has your thesis on bonds changed? No, thesis on bonds haven't changed. But in the short term, and what you're talking about here, Mike, is that if we go back to, say, just kind of pre-June, late May, bonds had a big sell-off in prices. They got very oversold, and you had a very strong rally in bonds all during the month of June. Bonds rallied nice. Yields came down close to 4%. They got very overbought. And so since really kind of mid-June, bonds have been selling off, working off that overbought condition, and now they're back to being very, very oversold again. So there's kind of another tradable entry point. But that's kind of the whole point here, is that in the short term, markets are driven by trading activity. What are bond, right now that trade de jour has been, hey, I can short bonds and make money on it, and there's a huge short position on bonds. And so, the bond traders have control of the bond prices right now, but long-term fundamentals will matter. And at some point, this economy is going to slow down. It is going to start to get into more of a, kind of a recessionary track at some point. Again, may not be this year, could be next year, could be year after this. The Fed is going to have to start aggressively cutting rates. And when that happens, all those traders that have been shorting bonds for profitability are going to have to cover those bonds. And then that provides your impetus for, much lower yields and higher bond prices. But again, that could be a wall off here. But the thesis of the underlying fundamental dynamics of bonds hasn't changed.
No, and in fact, the fundamentals have been improving for bonds while the narratives seem to be getting stronger, and that creates a divergence between a fair value, at least a fair value in our heads, and what the current price, which is the current value. And the bigger that divergence, the bigger the opportunity. But that doesn't mean it's going to happen tomorrow. In fact, that divergence can get even larger because it's the short-term trading dynamics that are impacting that, not the fundamentals, until those fundamentals flip the narrative.
Right. And look, and really important here too, because when you and I talk about bonds, everybody just assumes that we just own 10-year treasuries and that's all we own. And that's really not the case at all. And also we adjust our bond portfolio fairly often. In fact, we just made an adjustment this past week that, basically it moved some of our intermediate term duration bonds into shorter duration bonds to take advantage of what we think is going to be the Fed having to cut rates a little bit more aggressively this year. And maybe even sooner. We may see, potential for a July rate cut, with some of this latest data. Maybe we'll see, but probably the first rate cut won't come until September. But if the Fed does start cutting rates, that provides a boost to the kind of the shorter end of the curve. So we've adjusted duration in our portfolio. About 20% of our whole portfolio is in very short duration, 1 to 3 years. So we have about maybe 5% exposure to longer duration bonds. It's a very small holding relative to the portfolio, but in a 60-40 model, we have to own bonds. It's not a choice. It's a function of the portfolio construction, but it doesn't, when we talk about 60-40 allocations or 70-30, 80-20, it doesn't mean that we own all long duration bonds, and we're constantly adjusting that duration within the portfolio as well. So we'll come back, finish that conversation up with Michael Lebowitz, and then get into the Meh 7. His latest article is out on the website right now, realinvestmentadvice.com.
Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Last night I got home and my wife was all excited. I went to ChatGPT and I've laid out a whole business plan for a coffee shop. I'm like, oh God.
The Real Investment Show podcast.
Well, a long time she's wanted to have her own bakery and I've been slowly encouraging her not to.
Same show, your schedule.
So I may be in the coffee shop business here soon, so I may need your help to support my wife.
The Real Investment Coffee Shop.
Exactly.
I like it. It's got a nice
like
ring
the
to
sound
it.
of that.
Exactly.
We'll have a couple soapboxes in the corner. We can stand up and we can put them to sleep with economics. Then they need more coffee, and then we'll go through. We'll sell so
Brilliant.
much.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Quick announcement here this morning. Some changes coming to the Real Investment Show here soon. When I started radio back in 2001, roughly? Yeah. Brent's nodding his head. Brent was the operations manager at the radio station that I suckered him in to let me get on the radio at the time. There's a long story behind it that's actually kind of humorous, and maybe someday I'll share that whole story. Brent and I can reminisce about the old days. But in 2007, I switched radio stations and came to KSEV in Houston, Texas, and have had a very, very long and nice stint at the radio station, and much gratitude to the radio station for giving me the opportunity to share financial advice with you all these years. It's been fantastic, and I've been very lucky to have had that opportunity that they gave me to do that. But that is going to come to an end at the end of this month. So on August the 1st, it will be our last radio broadcast. Now, we will be moving everything into digital format. So if you're listening to the radio this morning, be sure and go to YouTube, subscribe to our channel at YouTube. It's The Real Investment Show on YouTube. We also stream live on X, and by the end of this month, I just informed Brent, we'll be streaming live on TikTok as well. We're going to also add Facebook at some point also. So we'll have, whatever your favorite social media outlet is, we will be streaming live to that. But it allows us to change the format of the show a bit, to do, a lot of different things that we've wanted to do for you for a long time. And again, much gratitude to the radio station for all these years of opportunity that they gave me. But it's just I'm starting to get older in my career, and so going to be moving to a full-time broadcast on YouTube. So be sure that you subscribe and like to the channel this morning. And, so that, sometime during your day, if you're listening to the radio show, just swing by YouTube at some point. Make sure you're subscribed. We'll notify you by email of when shows go live, et cetera. When we have special events, those type of things, you'll get notified. But it'll all be there for you. For you members in the chat right now, there will be new rules in the chat. And I'm speaking to you, Larry. We will be cleaning up chat also to make sure that these are good questions, because we're going to be using chat to communicate with you also during the show when we switch platforms. So we'll be taking live questions on the new podcast and doing a whole lot of different things. So we need to keep you guys focused on what's going on the program. So we will be cleaning it up and new rules, and Brent will be monitoring you, and bans will be issued on a regular basis.
It's like a sideband channel.
I know it will be. Correct. So just warning you now, chat, that we will be having to focus you on what's going on the show, so we can make it more useful into what's happening with the show. Anyway, so also make sure you're get signed up for the financial planning event, the Candy Coffee this weekend, with Richard Rosso and Jonathan McCarty. So that's on this Saturday, July 19th at 8 o'clock. So make sure you're subscribed at the website. Just go to the website, realinvestmengadvice.com, get signed up, and they'll go over all your retirement issues this weekend. So Mike, just before the break, left off talking a little bit about, kind of some of the misnomer about how we manage bonds and portfolios. A lot of people just assume we own long duration bonds. I just kind of made the statement. Did you have any concluding comments on that?
No. We, there's a fine line between being active in bonds and riding them out. And it's tough, and riding it out isn't the right word, but they're called fixed income products because they kick off coupons, dividends that are reliable, unlike most stock dividends. So when you hold a fixed income portfolio as part of a broader strategy, you're getting ballast. You're getting that income. You're getting a hedge. So when you're managing fixed income within a broader portfolio, you're thinking about the whole portfolio and how does it impact? How does it hedge? How does it manage risk? And then within the fixed income portfolio, we're looking at the fundamentals and all the options and what the markets are telling you versus what the fundamentals are telling you, just like we do on the stock side, but on the bond side as well. So it's just important to put it in context. And like we say with all our portfolios, you can't focus on one line item. You have to focus on the total return of the portfolio, because your portfolio is your wealth, and that's your goal. So just some 2 cents from 10,000 feet.
Exactly. So, kind of switching gears here a little bit. I was talking earlier in the show about this kind of surge in kind of market, kind of retail speculation in the markets. And, that's one of kind of the near-term concerns that I have about, potential kind of just a market pullback, if nothing else, just a relaxation in the markets. But you just wrote this article yesterday, which kind of feeds right into that, because the top three holdings, and I actually just posted a tweet on this morning. Let me see if I can just drag this up here real quick, just for the audience to look at, because it's actually quite stunning what retail here it is, right here. So this is a chart of retail activity, and you can just see that there's been this straight surge higher, this just really of anything that we've seen in the past. But here was the interesting stat in this. Retail's share of total single stock trading volume has reached 14%, highest level since 2018, even surpasses the 12% that was recorded during the meme stock frenzy of 2021. But here's the point. Individual investors' top holdings are NVIDIA, Apple, and Tesla, $472 billion, $284 billion, $256 billion, respectively. Retail investors now own more than $1 trillion worth of those three stocks. And what I find fascinating about that, Mike, is that Apple and Tesla have not been big performers in this recent Mag 7 run-up.
Right, but they both have their own fan clubs.
Yeah.
Like if you were actually to tell me who has the biggest fan clubs of the Mag 7, it would be those three stocks.
Yep.
NVIDIA, Tesla, and Apple.
Yep.
And, here's the other thing, and we see it all the time. People have incredible gains in those stocks. So maybe it's not that they're so enthusiastic about it. They don't want to sell it and realize the gain for tax purposes. But it's interesting, like, I just wrote the article, The Magnificent Seven, and if we didn't have SEO requirements, Lance, it would have been the Magnificent Seven. Exactly. But dashes and other things get in the way of writing good titles. Anyway, what I did was, this year has been very different than the last couple of years regarding Magnificent Seven. How many times, Lance, if I told you what the Magnificent Seven were doing, could you tell me what the stock market was doing and what our portfolio was doing in 23 and 24?
Yeah.
Maybe 101% of the time?
Exactly.
I mean, it really drove the market. And the more you had invested in the Magnificent Seven, the better off you were. And it really didn't matter which stock. In 2023, Apple was the worst stock in Magnificent Seven. It doubled up on the market. In 2024, Microsoft did a horrendous job. It was up 13%. The market was up 24%, but Microsoft tripled the S&P the year before. Those are your two worst performers. On average, the Magnificent Seven beat the market 3 to 4 times in 24 and 23. So this year, the Magnificent Seven on average, and I'm not doing weighted averages, but just on average is roughly flat to the S&P's 5 or 6% gain, whatever it is. And there's only 3 stocks that are leading it. It's NVIDIA, Meta, and what's the other one? Microsoft. Microsoft coming back from the dead from only being up 13% last year. Those 3 stocks, everything is underperforming, with Apple down 13%, Tesla down 20-something%, and some of the other stocks just underperforming the S&P. So the question is, what's going on? And there's a couple interesting things. The first thing to think about is just market volatility. 2023 and 24, there was very little volatility. The number of 2% up or down days was 3 between those 2 years. There was none in 2023 and only 3 in 24. We've had 6 already, and we're only halfway through the year. But also, if you look at implied volatility and realized volatility is the actual volatility, implied is what the market is expecting.
Yeah, could you actually explain that there real quick, just for our listeners, because again, we talk a lot about volatility, and I don't think most people realize there's 2 types of volatility. And so, could you explain a little bit more about what actual and realized are?
Right. So volatility is really just measuring standard deviations, getting into statistical geek talk here. It's measuring how much things are moving up and down. So realized volatility, you go back and you look at previous prices, whether it's closes 10 days, 20 days, 100 days, whatever it may be. And you say, okay, how much did it wiggle around? And if it's a flat line, that realized volatility be close to 0. And if it's a big roller coaster, that number is going to be much higher. Typically, realized volatility is in the mid-teens for the stock market. Companies like NVIDIA are in the 20s to 30s. Companies like more high flyers like the Palantirs, Palo Alto Networks are more in the 50s. So it gives you both an idea of how they've been whipping around, right? A lot of those, the Palo Alto and Palantir, for instance, are going up and down a few percent a day. The market, S&P, is rarely going up and down a few percent a day.
Yeah, real quick, we'll come back from the break, and thank you for that, Mike. And when we come back from the break, we'll go back and I'll show you a chart of realized volatility on the S&P. And this also explains why Mike and I just added some out-of-the-money S&P puts in our portfolio that I talked about earlier in the show today. So we'll come back and talk about that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I don't understand these emotes in chat, these little tags that are showing up. So I just responded to Larry in the chat, and I'm now the number one something or another that's...
You're the number one fan of you.
I guess I'm the number one fan of me. I like it. I don't understand
the
chat.
Social media universe.
Yeah, I don't get it. Everybody's got to have a little... I've unlocked a new level. So... Anyway,
Lance, I got a question.
Yes, sir.
Are we going to be able to interview Larry Smith when we change our format?
Probably not. Only from the stuff that he talks about in chat is not available. Kind of not prudent for actual live broadcast. So we'll have to see. Anyway. So just talking a little bit about Brent, can you bring up this chart for me? This was a chart from, so Michael Lebowitz has a new article out on the website this morning. It's at realinvestmentadvice.com. It's talking about, it's really the Magnificent Seven, talking about really the whole Mag 7 drive so far this year has really just been driven by a couple of stocks, most importantly NVIDIA, which is now a $4 trillion company. But this is a chart of actual versus, or I should say, the volatility versus realized volatility. And you can see that realized volatility in just the last month or so has dropped sharply post that Liberation Day surge. And this is what Mike's talking about. Implied volatility and realized volatility are both very low right now. But this is, when you have this occur, this kind of suggests that really investors aren't worrying about risk. And when they're not worrying about risk and they're kind of convinced the market can do nothing but just go up, that generally tends to be a decently good contrarian signal. And this goes back to what we were just talking about before the break as well. This whole kind of surge in single stock trading by retail investors. Those are good contrarian signals. Sentiment is a very good contrarian signal for the markets. And generally, when you have very low levels of volatility, and again, it doesn't mean that it happens tomorrow, right? And it doesn't mean the markets are absolutely just going to crash and we're going to have a 50% decline. That's not what this means. What this does suggest is that risk reward is no longer, kind of balanced in the favor of reward. The risk side of that equation is now starting to rise, suggesting you could see a 2, 3, 4, 5, 6% correction in the markets. And when portfolio insurance gets extremely cheap, that's because nobody's buying it. And that's what kind of sets up the market for a correction of some sort, because when you run out of buyers, the buyers that are out there are at lower levels. As is always the case, sellers live higher, buyers live lower. And so this is why Mike and I were working yesterday along with Nick Lane in our portfolio management. We run a model called the Platinum Portfolio, which uses options. And so yesterday we were out looking for kind of cheap, out-of-the-money options for the S&P for later this year, because I think there's risk building that we're going to get some type of market correction of some sort. Again, not 20%, but 3, 4, 5, 6% sometime in August, September, I think is a more realistic, kind of a probability than not. Mike, your thoughts?
Well, real quick. So we talked about realized volatility. Let me just talk about implied volatility.
Sure.
Because whenever you hear the word volatility on Twitter, on CNBC, it's almost always talking about implied volatility.
That's the VIX index.
That's the VIX index. And basically what they do is it's a calculation. They're looking at options on the S&P 500, puts and calls, and they're just saying, okay, here's what the prices are on various puts and calls, in the money, out of the money. From that, they can deduce what the implied volatility is. So it's the implied realized volatility, if you will. And where that gets interesting is, and like you said, Lance, right now it's pretty low. It's been lower, but it's starting to get pretty low, meaning that investors aren't that fearful. So one thing you can look at is realized vol versus implied vol. And sometimes implied vol whips around, and realized vol can just stay the same. So the market's saying, we think there's going to be a lot of volatility, while the market isn't really showing that same volatility. Conversely, sometimes the realized vol can creep up and that's kind of a warning to you when realized vol is creeping up and implied volatility is flat to falling. The market's not paying attention to what's going on. So those are some of the ways you can use volatility to kind of help you think about what lies ahead and to manage your risk. But anyway, in that article, I looked at volatility and what happens when the market's up or down 2 or 3 or 4%. 95% of stocks go right with the market. And that certainly happened with the Magnificent Seven, that when the market was up a lot or down a lot, all 7 stocks were most likely going with the market. So interestingly, despite the fact that the return differentials this year are very divergent compared to everything we've seen in the past, the correlations between all the stocks with each other and the 7 compared to the S&P 500 is a decent amount higher this year than in prior years. So let's try to wrap our head around that. What I'm saying is that the stocks are going up and down, not to the same degree, but they're going up and down on the same days more often than they were in 2023 and 2024. But the degree to which they're going up and down is much different. So what the kind of the takeaway that I'm kind of taking out of this is that something has changed in the market, whether that's temporary and we're going right back to the Mag 7 for the second half of the year and continuing where we were, or something has changed. And parts of me want to say that there is we're seeing it, that there's a speculative tilt to the market, that the stocks with the highest betas are the ones that are doing the best. Magnificent Seven tend to have medium to high betas. They are extremely strong fundamental stocks. They're making a ton of money, revenues, earnings. Their growth rates, for the most part, are pretty fantastic. What's taken their place are companies with incredible potential. Some have earnings, some don't. but they're in these fields that we're going to see exponential growth in theory. And the question.
Yeah, no, and a great example, just a fantastic example of what you're just talking about is Palantir, which is in the AI space. They do AI development for the defense sector. They've also kind of expanded out into more areas as well. But this is a stock that trades at 600 times trailing PE. Forward PE is 207 times, and it trades at a price to sales of 115. Now, you got to be careful with that. Immediately, everybody will go, "Oh, you got that's just I got to sell it." NVIDIA used to trade at those types of multiples like 4, 5, 6 years ago. And, it has now grown into a lot of those multiples if you look at NVIDIA today versus back then. Because I wrote articles about, NVIDIA trading at 50 times price to sales and those type of things. Is like, this is, just very expensive. You got to be careful of that. But NVIDIA has grown into that. It now trades at a forward PE of 29 and a price to sales ratio of still 28, but still down, it's half of what it was, and the stock's at all-time highs. But the stock also had a 90% correction during 2022. So, there's risk. To your point, Mike, there's a lot of risk in some of these high beta names that retail investors are piling into, thinking there's no risk at all.
And think about this when you're comparing Palantir to NVIDIA. Palantir has so what you're trying to say is that who cares that the PE is whatever you said, 500, 600, because they're going to grow at 200% a year. As the earnings grow, catch up to price, the PE normalizes. So what we can look at is price is the PEG ratio, price to earnings to growth, to the expected growth rate. And what you find there is that NVIDIA is at 1.8. I believe the S&P is at 2.4, 2.6.
And Palantir's at 20.
It's right. Well, but first, the PE ratio, when you adjust for future growth, again, assuming they get that growth, makes it a value compared to the S&P 500.
Right.
And like you said, Palantir is 20. So the market's telling you that Palantir is very overvalued. Now, how can it not be overvalued? If that growth rate is wrong, if the market is underestimating the growth rate, which is what it did for NVIDIA for years. Right. NVIDIA had a high PEG ratio. It's kind of come down now to good levels. Dare I say it's a value stock, but it's on the value end of the spectrum.
Yep.
It's not what it was. So the market's betting that Palantir will follow the NVIDIA path. Maybe not the same necessarily growth and earnings and market cap, but that's the bet. And it's a more speculative bet than NVIDIA. And those are the kinds of bets. And look, Palantir is a much larger company than some of these other companies that are driving. Some of it's like Coinbase and Robinhood that are just trading at also astronomical ratios. So there's a bottom line is there's a more speculative bent, and we've seen it. You showed it with the retail numbers earlier. We can see it a number of different ways. But then that leads to the question, okay, well, let's say we are in the final stages of a bull market, and the speculation tends to increase in the final stages of a bull market. Are we in the bottom of the ninth with 2 outs and 2 strikes, or are we in the top of the 7th inning? And that's a big deal, because if you would have got out of the market in 1998, you would have missed tremendous gains. And that's where active management, managing volatility, managing risk, understanding the macroeconomic fundamentals matters. And that's where you can manage in an uptrend.
All right, that wraps up the show for today. Thank you so much. Be sure to like and subscribe to the channel. Again, that'll become much more important as we get into August. But have a great day. Get by the website, realinvestmentadvice.com. Get Mike's latest article and get signed up for this weekend's Candid Coffee on the Retirement Blueprint. See you back here tomorrow.